I changed one thing about my client's mortgage. It's going to save them over $500,000. If you're a homeowner, you're sick and tired of seeing how much interest that goes to the bank every single month on your mortgage statement, you found the right page. You might want to save this video and follow me because I teach you strategies every single day on how you can become the bank to yourself, save yourself tens, if not hundreds of thousands of dollars with one strategy called the first lien HELOC. The strategy is very simple. We treat a HELOC just like your checking account. You dump all of your cash and income into this line of credit because every time we make a deposit, we're effectively reducing our principal balance for dollar. Interest is calculated based off the average daily balance. As your deposits reduce your principal balance, so does your interest. Any excess cash or idle cash that you have laying around, sitting in a high yield savings or a money market or a CD or anything, move that cash into the line of credit, which further helps pay off the home even quicker. But the beauty of this loan is that you have access to this line of credit for 30 years. Most HELOCs will give you maybe 3 to 10 years that you can have access to on your draw period, but this has access for 30 years. Let me show you how this loan broke down. So they owe about $720,000 on their home. They have an interest rate of 5.875%. They've been in their home now for about 6 months. Their take-home pay is about $17,000 a month, and they've got about 100 grand sitting in checking and savings and other low-interest yielding investment accounts. So think of your checking account. Again, we've got $17,000 that goes in every single month. They're going to pay for all of their bills and expenses out of the HELOC. And at the end of the month, they have about $5,000 left over after everything's paid. Here's their current mortgage, 29.5-year payoff, nearly $800,000 in interest, paying back $1.5 million back to the bank. With our HELOC, we're paying off the home in about 7.5 years. It'll save them $580,000 in interest. They're paying about $213,000 in interest back to the bank. The average interest rate is 8.2%. Remember, this rate fluctuates every month, and our simulator is factoring in those adjustments. So even though with a higher interest rate, because of the daily interest calculations, we're only paying $213,000, which gives us an effective APR of 1.8%. Now, a lot of you always ask, why would I leave my low interest rate mortgage for an 8% HELOC? Here's why. The effective APR represents the interest rate that your 30-year fixed mortgage would have to have in order to cost the same amount in interest. I suggest you snapshot this and read it later. Because we're paying off a mortgage so quick, we're only paying this amount of interest. This loan would have to have that 1.8% interest to equate to the same amount of interest that we're paying on the mortgage. The beauty of this loan is that in 90 months, we'll be debt-free. We have a $700,000 line of credit, or you can stay in your current mortgage, still owe the bank $634,000. This one strategy could be the game changer that you've been waiting for. Comment HELOC if you want to see if you can qualify.